Good afternoon, everyone, and thanks for joining us. I'd like to welcome you to this Monday Minute Live Chat hosted by the Canadian Leadership Congress. Our topic today is private credit, the role it plays in asset owners' portfolios and where the opportunities and potential pitfalls lie. To talk about it, I'm here with Ryan Dunfield, CEO and Principal with SAF Group in partnership with AGF. Welcome, Ryan.
Thank you for having me.
So I guess my first question is a big one, I think, that is on a lot of people's minds. What do you think of the state of the private credit market post-COVID? Do you think the pandemic has reduced the opportunity set or added any new risks?
Sure. I think first off, disruption doesn't necessarily mean destruction. So undoubtedly, COVID has been very disruptive, generally speaking, to the market. A lot of these businesses throughout the globe had very disruptive events affecting sales, affecting their balance sheets. But a lot of these businesses have already recovered and in some cases are certainly thriving during COVID. But, we view, generally speaking, the larger part of the market has been disruptive. I think we've seen some businesses that perhaps were on secular declines. We've seen somewhat of an acceleration to those declines, which might make investing in those sectors perhaps a little bit riskier as a result of COVID. As far as private credit goes, we have seen certainly a large amount of what I would call sort of kicking the can with respect to defaults. So that's where we see lenders providing patience in covenant structures, patience in maturity dates, where they somewhat kind of kick the can to deal with today's issues tomorrow, which is, I think, a little bit thematic to disruption versus destruction. Some of these businesses or sectors that have seen an acceleration of perhaps a decline, those would be sectors I think for us we would want to stay away from. An easy one to sort of pick on, and we're certainly aware that there's some phenomenal operators in this space, but I think theater operators are going to be in a relatively challenged spot on the back of COVID, where stay at home has perhaps made the average consumer more comfortable with digesting new product at home as opposed to going to theater. But so there are going to be pockets of risks. I think generally speaking, we would have expected more, perhaps a longer repricing period for businesses that were affected by this COVID event in 2020 and into 2021. But I would say we underestimated just the level of liquidity that the governments were able to provide as support to the economy as a whole. And that certainly snapped back a lot of these businesses and in a general sense, compressed credit spreads, making yields much lower than we would have thought in a much quicker period.
Yeah, so I want to pick up on your point about the liquidity that governments have managed to insert into the system, and just sort of talk a little more regionally. We've typically focused on the U.S. private credit space. That's been the big conversation. But do you think there's potential in Canada?
We do. COVID aside, we think the setup in Canada is quite attractive for private credit, and it needs to be sized appropriately. So it's certainly, as a country with 1/40th the size of the GDP, it's going to be a smaller opportunity set. But the oligopoly of our financial services in Canada has resulted in the banks petitioning our central bank and regulator to sort of slow down the adoption of regulatory changes that came out of the GFC. And for all intents and purposes, those delays are somewhat coming to an end, where we're starting to see a phase in of these regulatory changes that will make the financial services more challenging for those banks to lend into the mid-market. And because it is an oligopoly and lacks competition, it sort of has a two-pronged effect on the private credit space. Number one, as long as the adoption of those regulatory changes are delayed, it results in the few financial players to somewhat crowd out the market, as they make it challenging for private credit to sort of bud their way into the market. But then secondly, when those changes start to be adopted, because you have so few market participants, the funding gaps can be quite significant if you start to see a pullback in the bank market. And in the US, on the run issuances, the banks make up 30% of the commercial loan market. In Canada, the banks make up about 90% of the commercial loan market. So even small changes to sort of balance the loan market to look like the United States or look like Europe will have a pretty prolific effect on the private credit market, and in particular, borrowers looking for alternative sources of financing.
So is that actually going to make the Canadian market big enough for asset owners here?
Size matters. And I think, for us, we believe in the medium term, in order to maintain a level of underwriting standards that we feel comfortable with, that it's a $500 million opportunity set. If the Canadian market replicates Europe and the US, it certainly will be an opportunity set far in excess of a $500 million opportunity fund. It'll be multiples of that, but we feel pretty convicted that based on the current competitive landscape of substitutes to the banks, that we should have a pretty clear runway for investing into the Canadian private credit space.
Great. So you mentioned some of the opportunities you're steering away from, including theaters, for example. But where are you finding the biggest opportunities? What are you focused on right now?
Yeah, so as a credit investor, we're okay with boring businesses that are, perhaps not hyper growth. They're in the widget making part of the market. We don't mind these boring businesses. They tend to be very good businesses to lend in. They have very low volatility. The collateral that you're lending against tends to have a very predictable liquidation value. So we in the short term, we continue to like boring businesses, and inside of Canada, that'll somewhat reflect our GDP. So that is, industrials, businesses, supply chain sort of financing, manufacturing, some price taker markets as well that are quite capital intensive. But when we look at opportunities in the medium term or midterm, we really need to sort of focus on opportunities that we think are a function of this supply disruption that we predict because of banks somewhat exiting the mid-market. And so those are businesses that are going to be capital intensive on the balance sheet of the bank. So those are going to be businesses that have low ancillary revenues, which I think are consistent with our view of boring businesses. So they might not have the capital markets revenue sources that banks are looking for, especially as they're lending in a very low interest rate environment. Project finance is very capital intensive for the banks and is going to be more capital intensive as they adopt some of these mark-to-market changes. And of course, longer durated credits are going to be and are rather challenging for banks. So we see, those opportunity sets in the medium term focused around, what are the most burdensome on the balance sheet of the banks. Now, certainly in the short term, good businesses that were affected by COVID that need to sort of get their products back on the shelves, they're going to have working capital requirements. Banks that are backwards looking on EBITDA, covenant tests, when these businesses need to ramp up their working capital, those types of traditional covenants don't make a lot of sense to those businesses. So we will be looking at businesses that we feel have defendable market share and really just need to get their products back out into a more functioning market.
Yeah, let's step back and look at the entire space for a minute. Credit quality is always top of mind. You've touched on it a little bit. Can you tell me how you think it's evolved over the last couple of years, and how quickly you think things might turn around once we get to that point where everyone's vaccinated and we can start to move through the economy again?
Yeah, and we stop fantasizing on Expedia websites and holidays return or vacation holidays or vaccination holidays. So yeah, what's interesting about private credit is it's certainly become a very real allocation for institutional investors inside of their alternative bucket. And I think that trend really accelerated 5 to 7 years ago and picked up steam going into 2020. So I would have said that, at the end of 19, we were somewhat feeling like we were building a bit of a credit bubble inside of private credit. And then, sort of COVID hit, there was a pretty rapid repricing of assets. Some phenomenal opportunities where forced selling took place in the credit markets. And then here we are fast forwarding 6 months, and it sort of feels like the bubble may have gotten a little bit bigger. And I think a lot of that has been driven by a lack of supply. So you've seen credits, this is more of a North American or global comment, but you've seen, a lack of supply as we've seen this kick the can with existing asset owners, and not a lot of new credits coming to market. But then a lot of this dry powder that was struggling to deploy in 2018-19 really needs to get deployed in the second half of 2020 and into 2021. And we've certainly seen this return to covenant light credit structures, especially in some of these more competitive sleeves of the market, perhaps like the sponsored loan market, where credits are getting priced at attachment levels far higher than even in 2019, and credit spreads above risk-free rates have returned or almost surpassed the bottoms that we saw in 2019. So I think if you're looking at private credit strategies that are in competitive parts of the marketplace, you may find that you're just not getting paid for the risk that you're taking, especially if your credits are having 6 times EBITDA, 7 times EBITDA attachment levels.
Wow. Okay. Let me throw another spanner into the works potentially. We're now eyeing a rising rate environment. So tell me how you think that might impact the space.
Yeah. So specifically on the direct lending side of private credit, there should be a portfolio manager should be managing fixed versus floating to protect against some of that rising interest rate environment. Or if there is a significant amount of fixed credit spreads, that the duration or the loan maturities are being appropriately balanced by the manager, so that they're able to reprice into that rising interest rate environment. Special sits or opportunistic credit, I would suspect that the fixed credit spread that is being negotiated with a borrower has a high enough credit spread to absorb some of the convexity inside of the interest rate curve, which is really just, I suppose, a fancy way of saying you better be earning enough spread to take into account a rising interest rate. The flip to a rising interest rate environment is you should see your collateral supporting your secured lending, also participating with that higher interest rate environment, meaning that you've got essentially better quality collateral. But the flip to that better credit collateral is your borrower is probably less incentivized to take you out if they're going to have to reprice that credit at a higher absolute cost to themselves. One of the other negatives of that rising interest rate environment is the banks start becoming more competition for private lenders, as well as other direct lenders that are quasi-financial institutions, such as insurance companies, because the burden of a fixed cost structure starts to sort of ease at a higher interest rate. So I think it's really important for investors to understand the strategies that they're getting into and how the manager is managing their duration risk by virtue of fixed versus floating and their maturity dates, and ensuring that the credit spreads inside of their more special sits deployments truly have accommodated for convexity inside of interest rate curves.
Okay, let's look at pitfalls from the perspective of asset owners, pension investors. What do you have to say about those pitfalls in the private credit space that you think our listeners should be aware of today?
I think there's private credit, like a lot of these alternative asset classes, has had some crowdedness at the very sort of top of the market or in these mega funds, where we're finding that on the larger credit issuances, all of these mega funds are competing with each other, and so are the co-investment dollars. And so I think the co-investment might be frustrating for allocators because they're just not getting those co-investments deployed to the magnitudes that they were hoping for. And then ultimately the underlying credits that are being invested into are turning to be very, very competitive. And again, I would say that's at the sort of sponsor market, the larger issuances, very, very borrower friendly terms, very covenant light transactions. So I think it's, important for the pension investor to understand, how competitive the landscape is in the strategy that they're allocating to. With assets sort of allocated in certain parts of the market, that will and is resulting in niche strategies popping up, where some of these mega funds used to participate, that they're maybe having to get sucked out of as they focus on larger deployments. It also can sometimes result in a bleed of strategy drift of these mega funds into niche strategies, because they're also struggling to deploy in some of these larger investment opportunities. So I think you have to be very cognizant that, is your niche strategy going to be exposed to style drift of a mega fund when adjudicating a manager? And then this kick the can comment I made earlier, I think it is extremely important for a pension fund to really understand the valuation policies of a manager. Mid-market credit managers that came into COVID with a large exposure, should certainly have a certain portion of their book under a level of stress, despite the fact that the default rates might not suggest such, and really combing through those valuation policies and the portfolio level statistics around short-term amendments should uncover the risk inside of that portfolio before before a allocator steps into that manager.
That's a really good point. I've read a lot about a potential or looming supply crunch in the private credit space, and I'm wondering how is that something that you've seen, and how do you think that's impacting some decision making right now?
Yeah, supply crunch as far as deal flow being available to managers.
Yeah.
Yeah, I think you've got, especially today, two things participating. One is just this like general thirst for yield. The high yield market, last time I checked, I think BB spreads are 3.5%. That's really historically low on an absolute basis, especially if some of those high yields are unsecured. So there is this just general search for yield that capital is looking for at a time where we've never been more liquid as a global market, and that is driving down spreads and just generally creating more competition. And at the same time, issuers that should be coming to market where their businesses might be managing through a little bit of turbulence, they're very hesitant to open their credits into the marketplace. And so that's where you're seeing some of these short-term amendments or kicking the can playing out, and those issuers aren't hitting the market as we would expect. And I think that's very similar to what we saw in 2009 and 2010, where loans that should have been defaulting never really defaulted. They sort of had these pretend to extend take place, and we're seeing that today. So you've got an undersupply driven by too much demand, which is making the market look smaller than it historically is. And you also have a lack of issuers coming to the market, whether it's because of not wanting to open up and reprice their credits, or tapping these substitutes like the high yield market, where you can have these essentially non-covenant unsecured deals priced at 3.5%. So, for us, that's a market we're just afraid to go anywhere near. We want to, focus on a market that just wouldn't have the size or scale to access the high yield market. And we're really substituting, banks where they're almost willing to give these clients away because they can't get the return on risk adjusted capital on the relationship.
That's a really interesting point. So based on that, where do you see private credit evolving in the future, preferably post-COVID?
Well, it'll be fun when we're not talking about COVID effects on the capital markets. But I have a sense, given what the central governments have done around the globe, that we'll be dealing with the aftermath for some time. There is certainly this long-term trend that has been set up post-GFC that will continue to be set up, where non-bank lenders make up a very large part of the marketplace in the commercial lending arena. And the bespokeness of commercial lending makes it rather challenging for banks to wholesale off these credits, where we have MBSs and certainly CLOs to an extent in the commercial loan market, or CMBSs that allow banks to sort of wholesale or inventory their credit exposure. Direct lending is just rather challenging to put into a CLO or put into a securitized product. And as long as central banks continue to want to manage the too big to fail risk of their financial institutions or their financial markets, you're just going to have this need for non-bank lenders to continue to participate in the marketplace. Some markets that have been dealing with negative rates as well as early regulatory adoption, such as Europe, there's been a huge change in an acceptance rate of borrowers of non-bank lenders. And I would say the US is very much kind of on the heels of that. But there are markets like Canada or Australia that have very stable regulatory regimes and very stable rule of law that are accommodating for lenders that haven't sort of fully adopted some of these regulatory changes around bank regulatory capital, and those should provide some outsized returns here in the medium term.
Great. Well, that wraps our questions for today, Ryan, and I'd like to say thanks very much for joining us and for the excellent comments. And I'd like to thank all of you joining us for today's Monday Minute. Don't forget to send us your questions and we will get right back to you with Ryan's response. Thanks again for joining us, and see you next time.
Thanks very much.